So imagine you're producing a television show.
Okay, I'm with you.
You spend, hundreds of millions of dollars over a decade.
Yeah, right. Paying the actors, building those massive, elaborate sets.
Exactly. Marketing the premiere of every single season. You take all of that financial risk up front.
Huge risk, yeah.
But now, imagine realizing that the single largest payday of that show's entire lifespan, the moment that generates the highest margin of pure, unadulterated profit, is going to happen 10 years after the pilot episode first aired.
That is just, it sounds totally counterintuitive.
It really does, but that is the bizarre reality of the legacy media business right now.
Yeah, it absolutely is.
And if you're holding media stocks in your portfolio, it's this hidden ace up the sleeve that you absolutely have to understand. Mm-hmm. So welcome to Talk Tickers. On this deep dive, we are taking our source material, which is the Q1 2026 earnings call for AMC Global Media, ticker symbol AMCX, and we're breaking down exactly what their financial data is signaling for you, the retail investor.
Because there's a lot of noise out there.
Tons of noise. So our mission here is to bypass all the Wall Street jargon, look at the raw, cold data, and extract the actionable takeaways.
And just to be crystal clear at the top here, we are analyzing AMC Global Media, right? The content studio behind prestige TV like Mad Men, Better Call Saul, The Walking Dead universe.
Right. Not the movie theaters?
Exactly. We are not talking about AMC Theaters, the cinema chain. They're completely separate entities.
Yeah, AMCX even changed its name to AMC Global Media recently, just to, emphasize that shift, to show they're moving from being just a bundle of cable networks to functioning as this worldwide production studio and IP library.
It is a really vital distinction to make, especially because the financial profile of a global studio licensing its intellectual property, it's fundamentally different from a company relying purely on linear cable distribution.
Completely different.
AMC is currently executing one of the most aggressive, complex transitions in the entire modern entertainment sector.
Well, let's look at the scoreboard, right? Let's get right to the headline numbers from the first quarter.
Let's do it.
So top line revenue came in at $542 million.
Okay.
Which is down 2% year over year. Then you have adjusted operating income, or AOI, which landed at $69 million.
That's quite a drop.
Yeah, it's a steep 34% drop year over year. It leaves them with a 13% margin. But, and here's the picker, the third metric, free cash flow, came in at a very solid $65 million for the quarter.
Right, which creates this fascinating contradiction when you look at them side by side.
Yeah, because revenue is barely scratched. Down just 2%. But the operational profit, the AOI, took a massive 34% hit.
It's basically a leaky bucket situation.
Exactly. It's like an ice cube melting in the sun while management is frantically trying to build a refrigerator around it. The linear business is melting, and the costs of building that digital streaming refrigerator, it's severely dragging down the profit margins right now.
That melting ice cube dynamic is exactly what we are seeing in that AOI contraction. But to truly assess the health of the business, we really have to isolate what adjusted operating income actually measures versus what free cash flow measures.
Right, because for the listener, AOI is Wall Street jargon. Let's translate that.
Yeah, so AOI gives us a look at the core operational profitability. It strips out non-cash items like depreciation, as well as taxes and interest.
So it's the daily engine of the business.
Exactly. And a 34% drop in AOI tells us that the friction of this transition, the cost of running the legacy cable business while simultaneously funding the streaming build-out is just intensely expensive right now.
Right.
However, that free cash flow number of $35 million tells a much more stabilizing story.
Because free cash flow is the actual cash moving into the company's bank account, right? After all the operating expenses and capital expenditures have been paid.
Yes, it is the unencumbered capital.
Right, the cash they can actually use to pay down debt or buy back stock. So if the profit is down 34%, but they still generated $65 million in pure cash, they aren't bleeding out.
No, not at all. They are just front-loading their expenses.
Yeah.
$65 million in Q1 puts them perfectly on a glide path to hit their stated full-year guidance.
Which was $200 million, right?
Exactly. $200 million in free cash flow for the year. They are basically sacrificing near-term accounting margins to secure long-term cash stability.
And the market frequently misprices companies undergoing this specific type of transition, don't they?
Oh, constantly. Because algorithms and, headline scanners, they react instantly to a 34% profit drop.
They just see the margin compression and hit the sell button.
Yeah, exactly. But if you look at the actual mechanics of the cash flow, AMC is maintaining incredible operational discipline here. I mean, they are generating the cash required to fund their own survival without having to tap into predatory debt markets.
Right. They're paying for their own pivot. So let's break down the underlying forces pulling at that top-line revenue number, because we have a severe tug of war happening between the legacy business and the digital business.
A very violent tug of war.
Yeah. Domestic affiliate revenue plummeted by 16%.
Wow.
And for anyone new to media economics, affiliate revenue is the money AMC gets from traditional distributors like Comcast or Charter Spectrum.
Right, the old cable bundle.
Exactly. In the old ecosystem, AMC received a guaranteed fee for every single household that had a cable package. It didn't matter if anyone in that house actually turned on the AMC channel or not.
And a 16% drop there is just, I mean, it's cord cutting quantified in brutal terms.
It really is.
Yeah.
Millions of guaranteed wholesale subscriptions are vanishing as people just cancel traditional TV.
Yeah, and that 16% decline, it represents the permanent erosion of arguably the greatest business model in the history of entertainment. I mean, the traditional bundle was an anomaly of forced bundling, and that revenue is never coming back. But the counterweight in this tug of war is their domestic streaming revenue.
Which grew by 11%, right?
Exactly. Bringing them up to 10.1 million reported streaming subscribers across all their platforms like AMC Plus, Shudder, Acorn TV.
Okay, but those two numbers, the 16% drop in linear and the 11% gain in streaming, they don't offset each other cleanly at all.
Not even close.
Because an 11% gain in streaming does not replace a 16% loss in affiliate fees. Mostly because the economics of retail streaming are notoriously hostile.
Very hostile.
I mean, if AMC goes out and tries to acquire a direct-to-consumer subscriber, like if they try to get you, the listener, to sign up, they have to spend massive amounts of money on Google or Meta ads.
Right, that customer acquisition cost or SAC.
Yeah, that SAC eats right into the margin.
Yeah.
And then the moment that subscriber finishes watching the new season of Dark Winds or...
Then cancel the app.
Exactly. The churn rate is relentless. So you have high acquisition costs and high churn on the streaming side, and that's battling against a melting linear business that historically had zero acquisition costs and near zero churn.
Which brings us to the single most important strategic initiative management discussed on this entire earnings call.
The hard bundle.
Yes. The hard bundle. CEO Kristen Dolan has been aggressively pivoting AMC away from that brutal retail direct-to-consumer warfare. She is moving them back toward a modernized wholesale model.
I really want to spend some time on this because understanding the hard bundle is crucial to understanding the bullish thesis for AMC here. Let me define the concept for a second.
Please do.
A hard bundle means AMC negotiates directly with a distributor, like a broadband provider, a satellite company, or even a cell phone carrier.
Right.
And they bake the AMC Plus app directly into that distributor's existing customer packages. So instead of AMC trying to convince you to pull out your credit card and sign up for AMC Plus for $8 a month.
Which is exhausting and expensive.
Right. Instead of that, they go to Charter Spectrum and say, hey, pay us a discounted wholesale rate, and you can include the ad-supported tier of AMC Plus in your standard TV or internet packages.
And the economic beauty of that model is that it entirely eliminates the two massive problems you just mentioned.
The SAC and the churn.
Exactly. When AMC signs a hard bundle deal with Charter, they acquire millions of potential viewers with a single signature. The customer acquisition cost drops to zero.
Oh, wow. Yeah. Because Charter is doing the distribution.
Exactly. Furthermore, because the app is included in the customer's broader broadband or cable package, the customer is not actively managing that subscription every month.
Right. They don't cancel AMC Plus when a show ends because it's just a feature of their internet bill.
Right. So the churn drops to near zero. Management actually noted on the call that they have already driven 1.8 million hard bundle activations through partners like Charter and Philo.
And they just announced a new deal with DirecTV to roll out later this year, didn't they?
They did.
That is a fundamental shift in unit economics. I mean, they are accepting a lower average revenue per user because they have to give Charter a wholesale discount. But in exchange, they get guaranteed volume, zero marketing expense, and stabilized retention. It's basically replicating the old cable bundle, but doing it via IT delivery.
It's a brilliant survival mechanism.
It is. But this pivot to wholesale streaming leads directly into what I thought was the most controversial moment of the entire Q1 earnings call.
I know where you're going with this.
Yeah. Management announced that while they currently have 10.1 million subscribers, they are permanently stopping the quarterly reporting of their subscriber numbers going forward.
Yes, a major shift in investor relations strategy, and one that immediately raised eyebrows across the entire analyst community.
I mean, I am going to push back extremely hard on this decision.
I figured you would.
Because I look at financial history, right? And there is a very consistent, very dark pattern when it comes to metric transparency. When a company stops reporting a core metric, it is almost invariably because that metric is collapsing, and they just want to hide the wreckage from the market.
Like who?
Like when Twitter stopped reporting monthly active users, or when Netflix stopped reporting quarterly guidance for subscriber additions. It usually means the growth narrative is dead. So, as an investor, why shouldn't I view AMC throwing a blanket over their subscriber count as a massive red flag?
Well, listen, your skepticism is entirely justified. Historically, you are right to be alarmed when transparency vanishes like that. However, we have to analyze this specific move within the macroeconomic reality of the 2026 media landscape.
Okay, lay it out for me.
Wall Street's valuation models have fundamentally shifted.
Right.
For the last 5 years, during the zero interest rate environment, the market rewarded media companies exclusively for raw subscriber growth. Disney, Paramount, Warner Bros. Discovery, they were heavily incentivized to burn billions of dollars in cash to artificially inflate their subscriber numbers.
Yeah.
Because the market valued them like hyper-growth tech startups.
Right, the classic Silicon Valley playbook. Subsidize the product, capture the market share, and figure out the unit economics later.
Exactly. But the era of cheap capital is dead. Interest rates are sitting much higher now, and the debt required to fund those streaming losses is suddenly prohibitively expensive.
So you're saying the market has completely reversed its incentive structure?
Completely. Investors are no longer rewarding subscriber growth if it comes at the expense of cash flow. Wall Street is now violently punishing streaming losses and demanding margin expansion.
And Kristen Dolan explicitly stated on the call that AMC is a smaller niche player, right?
Yes, she did. They simply do not have the balance sheet to engage in a subscriber arms race with Amazon or Apple. I mean, if AMC continues to report their subscriber numbers every 90 days, analysts will invariably benchmark their growth against the massive global scale of Netflix.
And that is a comparison AMC will always lose.
Always.
Okay, wait, let me challenge that rationale, though. Just because they can't beat Netflix doesn't mean retail investors don't have a right to see if the subscriber base is shrinking. I mean, if they are moving toward this hard bundle wholesale strategy, shouldn't they want to flaunt those activations?
Well, they will likely still provide qualitative color on their wholesale partnerships. But giving a consolidated quarterly headcount, it distracts from the actual financial health of the company.
How so?
Because by removing the subscriber metric, AMC is aggressively forcing analysts to reweight their valuation models. They are telling the market, do not value us as a hyper-growth streamer. Value us based on our $200 million in free cash flow, our adjusted operating income, and our debt reduction.
So they're taking away the vanity metric to force focus on the profitability metrics.
Precisely. It is a calculated risk to reposition the stock's narrative from a growth story to a value story.
I mean, that makes strategic sense from a corporate messaging standpoint, though it absolutely demands that you, the investor, trust the cash flow statements more than ever.
Oh, without a doubt.
Because if you are going to hide the headcount, your cash generation better be immaculate.
Has to be.
Well, let's pivot to the advertising side of the revenue equation, because the cash generation there was a very mixed bag this quarter.
It was.
Overall, domestic advertising revenue declined by 5%, and management cited, quote, lower marketplace pricing as the primary culprit. Let's unpack the mechanics of that. Lower pricing means the supply of advertising inventory in the broader streaming market has radically outpaced the demand from brands and agencies.
Yeah, we are seeing a structural glut of ad inventory right now.
Glut.
Yeah. Over the last 18 months, virtually every major streaming platform has introduced a cheaper ad-supported tier. Netflix launched theirs. Disney Plus heavily pushed theirs. And most disruptively, Amazon Prime Video flipped a switch and defaulted millions of its subscribers into an ad-supported experience.
Right, they just forced everyone into it unless they paid more.
Exactly. So suddenly, media buyers have an almost infinite supply of premium streaming inventory to bid on. And when supply scales exponentially like that, the clearing price for a 30-second spot plummets across the entire industry.
Ah, okay. So AMC is just catching the shrapnel of that macroeconomic supply shock.
It's basic commoditization.
But what is striking to me is that the underlying engagement with AMC's content is actually strengthening. I mean, Despite the 5% drop in total ad revenue, management noted that viewership ratings for their scripted shows in key demographics actually increased in the first quarter.
Which is impressive given the landscape.
Right. More people are watching the shows, but AMC is monetizing those eyeballs at a slightly lower rate because of those broader market dynamics you mentioned.
Right.
However, that 5% aggregate decline hides a massive surge in a very specific segment. President Kim Kelleher highlighted a 44% jump in digital advertising.
Huge jump.
That is explosive growth. So what is driving that digital surge while the linear ads are declining?
That 44% surge is the direct result of their aggressive expansion into FAST channels.
FAST channels. Explain that.
FAST stands for Free Ad-Supported Streaming TV. These are the linear-style channels you scroll through on platforms like Pluto TV, Tubi, or the Roku channel.
Oh, right, where it looks like a traditional cable guide.
Exactly. They run 247, playing older catalog content interspersed with commercial breaks. And AMC announced they currently operate over 40 distinct FAST channels, and they were preparing to launch a dozen more.
Okay, let's look at the financial architecture of a FAST channel, because it is incredibly efficient. AMC already owns the rights to decades of older content, so it costs them virtually nothing to package episodes of Portlandia or, old horror movies into a continuous 24-hour feed.
A very low lift.
Yeah. They hand that feed over to Tubi. Tubi handles all the streaming infrastructure and bandwidth costs. Then, whenever a commercial break hits, the ad slots are sold programmatically in real-time auctions.
Right, so AMC just sits back and collects a massive share of that programmatic ad revenue.
It's genius. It's taking dormant, fully amortized assets that are just sitting on a server somewhere and turning them into a high-margin digital cash machine.
It is the ultimate asset optimization strategy. I mean, they are mitigating that 5% decline in their legacy linear ad sales by scaling up this low-friction digital infrastructure.
And they aren't just doing it domestically, right?
No, they noted expansions of their FAST networks into the UK, Latin America, and Spain. They are building a global programmatic ad network on the back of their historical IP.
Wow. Okay, so we've dissected the first quarter pretty thoroughly. Now we really have to look forward. We need to evaluate the management guidance for the remainder of 2026.
The most important pair for modeling.
Exactly. For the retail investor modeling this out, management reaffirmed their full-year targets. They are projecting consolidated revenue of approximately $2.25 billion, adjusted operating income of roughly $350 million, and at least $200 million in free cash flow. But, and this is a critical warning for anyone holding this stocking, Chief Accounting Officer Mike Sharon was very explicit that the second quarter will be the lowest point of the year for AOI.
Yes, he was.
So the upcoming Q2 earnings print is going to show a severe dip in operational profit. Why?
Well, this is where an understanding of media accounting is absolutely essential.
Right.
So investors do not panic when they see that Q2 profit compression.
Right.
The dip is entirely driven by the timing of marketing expenses. In the second quarter, AMC is launching major summer tentpoles, primarily the new Anne Rice series, The Vampire Lestat, and the third season of The Walking Dead, Dead City.
Okay, let's clarify why that impacts the quarter so violently, though. When AMC spends, say, $50 million producing a television show, that production cost is capitalized on the balance sheet, right?
Right, and it's amortized over the useful life of the asset.
Over several years, exactly. It doesn't hit the income statement all at once, but marketing is different.
Completely different.
When AMC spends $20 million in May on billboards in Times Square, or huge digital ad buys on YouTube, and massive promotional events for all this, the Vampire Lestat accounting rules dictate that those marketing dollars must be expensed immediately in the quarter they are incurred.
That is the crucial mechanism right there. The cash goes out the door in Q2 to build the audience, severely depressing the adjusted operating income for that specific 3-month period.
But the payoff comes later.
Exactly. The revenue generated by that marketing spend, the new AMC Plus subscriptions, the elevated ad impressions on the FAST channels, the viewership on linear cable, all of that will be harvested over Q3 and Q4.
So management is actively telegraphing that their profit profile is heavily back half weighted this year.
Yes, they are.
So if you own the stock, you have to mentally prepare for the Q2 headline. The algorithms might trigger a sell-off when the profit dips, but if you understand the cadence of marketing capitalization versus expensing, you recognize it as a standard operational cycle.
Right. It's not a structural failure at all.
Okay, Now let's transition to the single most important catalyst discussed on this call. Because if the Q2 marketing spend is the short-term headwind, this next item is the massive structural tailwind that would fundamentally re-rate the entire valuation of AMC Global Media.
Yes, we need to talk about the Walking Dead licensing rights.
This is huge.
This is the focal point for any long-term bull thesis on the company. I mean, it represents a paradigm shift in how legacy media companies extract terminal value from their intellectual property.
Let me set the baseline here for the listener. The Walking Dead universe encompasses 7 different series and over 350 episodes of television.
It's massive.
Massive. And right now, the streaming rights to the most iconic, highly watched early seasons are locked up in legacy contracts with external platforms, most notably Netflix.
Right, Netflix has had them for years.
And Netflix has been generating incredible engagement off those early seasons. But those licensing contracts expire. And the global rights revert entirely back to AMC in January 2027.
Less than a year away.
AMC will suddenly have total control over one of the most binged television libraries in history. So from a pure accounting perspective, how does a massive IP licensing deal alter the financial profile of a company like AMC?
Well, it creates a margin profile that is almost unparalleled in modern business.
Really? Unparalleled?
Yeah. Consider the economics of original content creation, right? It requires massive upfront capital expenditure. It carries high execution risk. The show might just be a total flop.
Right.
And it takes years to break even. Conversely, licensing out a library of 350 episodes that have already been produced, already aired, and fully amortized on the balance sheet, that requires zero new capital expenditure.
So it's basically free money.
Exactly.
Yeah.
When AMC signs a licensing deal for that library, the revenue drops almost entirely to the bottom line as pure operating profit.
Yeah.
It is a massive high-margin cash injection.
And CEO Kristen Dolan noted they are already fielding significant inbound interest from major platforms, but she specifically emphasized the term co-exclusive rights, which is a vital strategic nuance. Because 5 years ago, companies were pulling all their content off Netflix to hoard it exclusively for their own streaming apps, right? Disney pulled Marvel, NBC pulled The Office. The strategy was total exclusivity.
Right, to drive signups.
But Dolan is signaling a hybrid approach here.
Yeah, and if you look deeper at the current data on content discovery, total exclusivity is often a huge mistake for a niche player like AMC.
Why is that?
Because co-exclusive means AMC will license the rights to a massive aggregator like a Netflix or an Amazon Prime for a substantial 9-figure fee. But AMC will simultaneously retain the rights to stream the exact same episodes on AMC+.
Oh, that is a masterclass in having your cake and eating it too.
It really is.
You take the massive licensing check from the tech giant to fortify your balance sheet, and you leverage their massive algorithmic reach to re-engage casual fans with the franchise.
Right, someone scrolling Netflix discovers it again.
Exactly. But you don't alienate your hardcore fans who specifically subscribe to AMC Plus for the zombie content. You monetize the IP across 2 completely distinct subscriber bases simultaneously.
And crucially, Chief Accounting Officer Mike Sharon explicitly confirmed that the current 2026 guidance of $350 million in AOI, it does not include a single dollar from this impending Walking Dead licensing windfall.
Wait, really? Not a single dollar is baked into the guidance?
Correct, because the rights don't revert until 2027. That means the market is currently looking at a valuation model that entirely omits an impending massive influx of high-margin cash.
Wow.
Yeah. And when analysts asked Dolan how they plan to slice up these rights, domestic versus international, streaming versus fast, she made it clear they are running complex econometric models on every permutation to maximize the yield.
Okay, so if we synthesize everything we've covered today, the transition to the hard bundle, the pivot to free cash flow over raw subscriber growth, the fast channel expansion, and the looming 2027 Walking Dead catalyst.
That's a lot of moving parts.
It is. But we have to arrive at the bottom line. What is the actionable takeaway for the retail investor listening to this? Are we bullish or bearish on AMCX?
Well, the data dictates a bifurcated verdict.
Okay, explain that.
If you are an investor looking for top-line growth, like if your portfolio is built on tech companies scaling revenue at 20% a year, this is a hard pass.
Because the legacy business is dying.
Exactly. The legacy linear business is structurally declining, and it will continue to exert a gravitational drag on total revenue. However, if you are a value investor intensely focused on cash flow generation, margin preservation, and corporate restructuring, there is a highly compelling bullish case here.
Because they're de-risking.
Yes. AMC is actively de-risking its entire enterprise.
You know, the de-risking of the balance sheet is truly the unsung hero of this quarter, I think.
Absolutely.
Across the media sector, companies like Warner Bros., Discovery, and Paramount are just being suffocated by their debt loads.
Crushing them.
The interest expense alone is crippling their ability to invest in new content. But AMC executed a series of financial maneuvers in Q1 that effectively neutralized their near-term existential risk. Let's break down exactly what they did, starting with the 2029 senior secured notes.
Right. So in corporate finance, companies often face what is called a maturity wall.
A maturity wall. Okay.
It's a year where a massive amount of debt comes due all at once. And in a high interest rate environment, hitting a maturity wall can force a company into bankruptcy or just highly dilutive refinancing.
It's a death trap.
Exactly. So AMC looked at their impending maturities and proactively executed an exchange offer. They swapped the vast majority of their notes due in 2029 for new notes that do not mature until 2032.
Wow.
And furthermore, they used the $428 million in cash they have sitting on their balance sheet to completely redeem the remaining unexchanged portion of those 2029 notes.
And they didn't even stop there. They also announced the termination of their credit facility and the paydown of their remaining term Loan A.
Which is huge.
The net result of all this financial engineering is staggering. By completing these transactions, AMC pushed roughly 75% of their total debt out to July 2032.
It is a phenomenal execution of capital allocation. By pushing the debt out to 2032, they have bought themselves 6 years of unobstructed runway.
6 years?
Yes. They do not have to worry about refinancing in a volatile interest rate environment anytime soon. Their net leverage ratio sits at a highly manageable 3.5 times.
So they're safe.
They've built a financial fortress, really. It allows them to navigate the linear to streaming transition without the threat of insolvency just hanging over their heads.
And because management is so confident in that fortress, they announced a $30 million accelerated share repurchase program.
A very strong signal.
Yeah, they're using their excess cash flow to buy back their own stock and retire those shares. As an investor, there is no stronger signal that a management team believes their equity is deeply undervalued by the market.
Right, because they're shrinking the float, which mathematically increases the proportional ownership and earnings per share for every remaining shareholder.
It demonstrates total alignment with shareholder value.
It really does. They are controlling the variables they can control. Minimizing debt risk, optimizing cash flow, reducing share count, while just waiting for the macro environment of streaming to stabilize.
All right, let's distill this into the final actionable playbook for you, the listener. If you hold AMCX, or if you are considering building a position, here is what you need to do. Number 1, hold steady through the upcoming Q2 earnings report.
Yes, very important.
We have thoroughly detailed the accounting mechanics of their summer marketing spend. The adjusted operating income will compress sharply next quarter. Anticipate the scary headlines, expect algorithmic selling, and do not panic. The profit is back half weighted by design.
I totally agree. Selling into an anticipated cyclical marketing expense is a fundamental error. Maintain your focus on the free cash flow generation over the full 12 months.
Number 2, set your alerts for any industry news regarding The Walking Dead rights. Monitor the trade publications. The moment AMC announces a co-exclusive licensing agreement with a major streamer, the financial models for 2027 will have to be completely rewritten.
Because that announcement is the primary catalyst that could trigger a significant re-rating of the stock price.
Exactly. That licensing deal will provide the exact cash bridge they need to finalize their transition into a modernized digital-first studio.
It's the linchpin to the whole strategy.
Which brings us to a final provocative thought to leave you with today. We have just mapped out a very specific corporate strategy, right? AMC is aggressively extending its debt maturities out to 2032, securing 6 years of runway.
Right.
They are prioritizing free cash flow and cutting low-margin retail subscriber acquisition.
Check.
They are buying back stock to tighten the equity structure. And they are organizing a massive, highly valuable, wholly owned library of intellectual property. The Walking Dead, the Anne Rice universe, the prestige dramas.
It's a very clean setup.
They are meticulously building a clean, highly profitable, de-risked fortress. But as an investor, you really have to ask yourself, are they doing all of this simply to survive as a standalone niche streaming network for the next decade?
Mm-hmm.
Or are they intentionally dressing up the balance sheet, stripping away all the financial liabilities, and making themselves look as attractive as possible to become a prime acquisition target?
Wow. I mean, that is the overarching question for the entire mid-cap media sector right now, isn't it?
It is.
Consolidation is the logical endgame of the streaming wars. When a massive tech platform, an Apple, an Amazon, or even a Sony, looks at the landscape, they might see AMC's pristine balance sheet, their manageable debt profile, and their deeply loyal genre fan base.
And what do they realize?
They realize it is significantly cheaper and faster to simply acquire AMC outright than to try and build that level of prestige IP from scratch.
Exactly. When you fix the foundation, pay off the immediate mortgages, and clean up the yard, the house becomes incredibly easy to sell.
That's a great way to put it.
We began this deep dive looking at a financial dashboard that felt contradictory and murky. We saw the friction of a legacy business model melting while a new digital model was being built.
The melting ice cube.
Right. But when you strip away the top-line noise, understand the accounting mechanics of marketing versus production, and respect the raw power of free cash flow, the picture clarifies.
It becomes a lot clearer.
The strategy is disciplined, cash generative, and intensely focused on survival and shareholder value. Thank you for joining us on this deep dive. Keep your eyes on the data, trust the cash flow, and we will see you next time.